Hey, Renter Retires, it's Adam Schroeder here with the new episode in 2024, joined as usual by the founder and CEO of Rent to Retirement, Zach Lemaster. And we are here to start off your new year with a bang because 2024 is going to be in my opinion, very different year than 2023. So, Zach, welcome to 2024.
Yeah, happy New Year, Adam. It's always an interesting time, is to kind of reflect on the past year and whether you're someone that follows like the New Year's resolutions or not. Like, I don't think you can avoid just being conscious about, all right, this is a new year. What are we wanting to accomplish? I mean, we just went through and reviewed kind of our company goals. We're super excited. We'll talk about some of those things today, but we're super excited about the direction we're going, things that we're bringing to our investor community that I guarantee you haven't seen elsewhere, just to allow you to be more successful investors. But yeah, lots of things to think about on the new year. And what about you? You got any resolutions you want to share publicly?
Um, Not publicly right now, I don't think, but one of my semi goals is to basically double our portfolio by the end of the year.
I love it.
That's one of our goals, or at least one of mine. I haven't talked to Aaron about it yet, but that's a conversation that needs to be had. But I want to remind everybody, this time last year, the conversation was around, you know, were we going to have a correction because interest rates were so high and inflation was so crazy. And then one short year later, we're in a situation where we say, how high is the housing market going to go because interest rates are coming down because inflation has been tamped down. So it's kind of crazy what can happen in a single year. And it's important to continue remembering that as we go into this year, because as we're going to talk about, we see a lot of movement ahead, and not just us, but people who are supposedly smarter than us who are on the Wall Street side of things. And the Fed has themselves said interest rates, their interest rates are going to come down, which tends to impact ours. So, I mean, heading into 2024, I've seen a lot more optimism from investors than I did going into 2023. So I'm excited about that as we, continue bringing real estate and continue hopefully inspiring people for their real estate investing journey. So, Zach, I know you've kind of seen good things on the front in 2024. What are you looking forward to most about this coming year when in the real estate market?
Well, let's just set the stage first of like where we're at with like economics, market cycles, rates, and just so everyone has a kind of a thorough understanding. And there's been a lot of noise and articles and publication about what the Fed's plans are. It should be no secret. The Feds have already, to make no mistake, like we're actually recording this in December, right? And we're not in the new year yet, but the Fed has already started to lower interest rates. And Adam, I know you have some stats to share with us, but there's anticipated, because I mean we've just went through the steepest increase in interest rates that we've seen in the past 4 decades. I mean that was extremely aggressive, right? And to your point, a lot of people anticipated there to be large economic corrections, housing market corrections, and that just hasn't happened. I mean, again, it's supply and demand, inventory shortages, et cetera, et cetera. So, I mean, it's been a slower year. There's been less buyer activity. That also means there's a lot of opportunity. But likely what we're going to see, Adam, is that the rates will continue to drop, probably rather dramatically over this next year. But any type of turnaround and dropping at this point after the past 18 to 24 months that we've been through is going to be a good thing. But what that's going to drive is it's going to drive a lot of investor activity. Like we're certainly excited about it because one, it's just going to mean more activity, right? Like our business thrives when there's more investors purchasing and
Yep.
buying. So naturally that's a good thing for us. But I think from the investor perspective, this is a time to think about like, look, rates are on their way down. Do not try to be one of these people that times rates. Understand that the buying criteria and the buying accessibility is the most important thing right now. Rates are a variable and they're always going to be changing. And you said it best in the beginning about this 2024 being a very different year. I would say I would agree with you that yes, it's going to be a much different year, but every year is different. Every year is different for every different reason. So like just understand the market, understand how to be a successful investor. We won't belabor those points because we talk about it all the time. But I think 2024, we're looking at interest rates dropping at least a full point. In addition to what's already happened, I'll let you share the stats, Adam. But that's certainly, I mean, we've been through this. I mean, what we will see is that, which is again great for our business, but just something to be conscious of for you as the investor, is that we're going to see a lot of a lot more buyer activity. That means more competition. That means likely appreciation, stronger appreciation in areas that have already appreciated. Most of the markets that we've invested in, as you well know, Adam, they still have seen strong appreciation both in rents and home prices in most markets because of supply and demand. But when we have more buyer activity, now all of a sudden it's going to be a seller's market again. So the point I'm making is that really over the next 4 to 6 months, I think before we start to get in this really aggressive buyer market again, or I'm seller's market where you have buyer activity, is now it's time to like make some moves. You don't want to be in a position where you're all of a sudden you're behind the 8 ball again. We have a lot of investors that, and I want to share some tangible takeaways with you guys too, as you're thinking about your investing path for this next year. We had a lot of investors that were scrambling, and even this in December. December was our best month in the past two years, but mainly because we have so many people scrambling to buy properties for tax purposes. And I would just encourage you, don't put yourself in that position where you got to buy something in December. Now I'm guilty as well, right? We closed more real estate personally in December than we did because there wasn't we're just sitting on stuff. There wasn't a lot of inventory out there. And some closings took longer than others, but it's best if you can come in, start the year strong, meet a milestone, and get ahead of the curve that we're going to see coming. Would you agree with that, Adam? And can you share some stats with us?
Yeah, absolutely. I mean, I have to agree with that because I wholeheartedly believe it. I mean, right now, kind of what you were saying is, as it's more of a buyer's market at the moment. I mean, if you look at our sheet now, just our inventory sheet, and look at what seller incentives are being offered right now, 2 years ago when rates were low, none of that was on there. Free property management for a year, never even considered offering it. Buying
That,
rates down,
that
never
stuff's
considered.
probably going away,
Yeah,
right? Soon. Take advantage of it now. You have more deal accessibility, better deals, less competition out there, and more incentives to purchase now. Like rates are kind of irrelevant in the big picture of these things if you're running your numbers. But yes, I'm glad you're sharing specific information because that's probably going to go away. I'd imagine as sellers and builders don't need to offer those things, right? So
yeah, absolutely. And I mean, rates right now, whenever I spoke with our lender, actually just yesterday, and said, hey, what am I looking at if I were to do it? He said, homes under 200,000, easy to get 6.75 to 6.5, and with maybe a point, 2 on the high side. If you're looking at a build of, or a home around 350,000, you're looking at 7.25 for those homes. So, I mean, that's at least a full percentage point down from where it was 6-7 months ago. So we've already seen a big drop in that regard. I mean, that's a 12.5% drop for those properties at a minimum. So we're seeing that, and we also saw. I mean, you sent me some articles about kind of what UBS is expecting in 2024. I mean, they're talking about Fed cutting stuff by 2.75%. I mean, that's huge. If you're talking about that kind of cut in a 9 to 12 month time frame, there's only one way that ends, and that ends with a pickup in buying as rates go down. Because with the lack of buying that's been happening among homeowners for the last year and a half, 2 years, they're all chomping at the bit because they are waiting. Renters have been waiting for rates to come down because they're actually looking at tying themselves into a payment that they're not going to have other people paying off for them. And they think, this is too high for me right now. I will just wait and get it whenever my payment is going to be lower. And we are looking at it a completely different way. And so we can jump on things while the rates are still higher before that massive frenzy comes in to shoot our value up. And then you can refinance later. You can pull cash out if it's strong enough. And then you're in a really, really good position.
yeah, I mean, and thank you for sharing those details, Adam. The point we're getting across, and then I want to get into sharing actually what our company goals are for 2024. And Adam, you're aware as we were kind of reviewing this as a team earlier this week, but the point is there's buying opportunity right now. Highly encourage you guys to get in front of the curve of the frenzy and take advantage of all these incentives. And you could, as Adam mentioned, you can always refinance, and one could argue, well, yes, but then I have to pay refinance fees. Well, guess what? If you use NAF, our number one preferred lender, not the only lender we work with, but our preferred one, if you refinance for the first 2 years, you have no refinance fees. I mean, we have found the best deals and best partners in all aspects to to bring you scenarios and opportunities that you won't see elsewhere because we want you to be successful. These are the same things that we're doing. So, I mean, just to summarize everything we're saying, this is the news that everyone's been waiting for, which is great, and we're certainly excited about it because it will increase our business activity. But from the investor lens, just think about this. Just to review Adam's point, we have a ton of inventory right now in excellent locations that builders have built, that they're sitting on. That means you can come in, you can buy it below market value. You can take advantage of seller incentives where they're buying the rates down, they're paying for closing costs for you, you're getting free property management. You're also locking in an interest rate that will cash flow now at today's numbers and have the ability to refinance for free within 2 years if you're using NAF to close your loan. That's huge, right? That could be some of those refinance fees. I mean, or thousands of dollars you're talking about to lower your rate. So it's really security all around. But buying before, I think probably, I don't know, May, June timeframe is where I anticipate things to really dramatically pick up. So the first part of 2024, I'd encourage you to set some strategic goals and then make or take action on them. One thing I want to share, so I'll share our company goals with everyone because I think there's some exciting things you need to be aware of as you formulate your goals over this next year. But also, I just want to share something too that I think is really relevant. One thing we've seen a lot in December, and one thing we've been working with some of our investors on, is to do creative things tax-wise, specifically around accelerated depreciation to offset your taxable liability. I probably had this conversation 10 times this week already because we're near the end of the year and people are trying to like decide how they do this. But here's I just want to share a few examples of how you as an investor can use a brand new built property and take accelerated depreciation to reduce your taxable income, even if you're not a real estate professional. And even if this is your first property. Disclaimer, I'm not a CPA or attorney. Check with yours. We have some for you if you want to talk with them. But help you strategically plan. But here's something I found very interesting. So there's been a few healthcare professionals and engineers, and I think one attorney that we have been working with that are high-paid professionals that have disposable income. They both spouses are working full-time. They're brand new investors, and so they would not qualify, like this is their first investment property. They would not qualify as a real estate professional to possibly take accelerated depreciation to offset their taxable liability. And guys, if this is high level for you, go back and look at some of our previous shows. We've dug deep into this. If you listen to even probably 3 or 4 shows, Adam can attest. Like we talk about this a lot because this is important and it is very relevant to what to everyone. I think and what we're talking about today is to make tax advantage real estate relevant to you, regardless if you can qualify as RE Pro. Now, if you have multiple properties and you're likely across a couple different states and you can qualify for RE Pro and take your accelerated depreciation on everything, fantastic. Likely save you tens of thousands or hundreds of thousands of dollars on taxes. Same thing we personally do with our investing. But for investors that would not qualify as real estate professional, again, you can look up what the qualification criteria is. There may still be a way for you to offset your taxable liability. And here is how some of our investors are doing it. Okay. Now this is coming out early 2024. So this would be, this podcast is, so this would be applicable to your investing goals for 2024, but you can start this now and still use it in 2024. So what a lot of our investors are doing, and we're working with them on this with their CPA's guidance, is they're buying new construction where they are furnishing the house and personally, and the investor, we're talking about the investors doing this, they're personally managing it for the first year that they own it as a short-term rental. Okay. And so what that does, and furnishing costs is about $8 per square foot, we found. So, I mean, you really don't need to furnish it extensively. $15K, which is also a tax deduction, is, 15 to 20K is more than enough to well furnish even a 4-bedroom larger house. But anyways, they'll furnish the house and they'll operate it as a short-term rental for the first year that they buy the house, and they will self-manage it. We've helped people set this up. We're not going to do it for you. In fact, you have to do it. That's part of it. But now it's an active business. Okay. And in the eyes of the IRS, it's viewed as an active business. It's like hospitality. It's also taxed as an active business. But that also means you can take accelerated depreciation on this property because it's an active business. It's a short-term rental. You're in the hospitality business, meaning the average stay is less than 7 days. 7 days or less. There's no requirement on how many days you rent it out. It's just the average stay. So if you have one stay that's two nights, you buy your property in November, December, whatever, and you have 2 nights that you're renting it out as a short-term rental, you throw an air mattress in there. I mean, I'm being extreme, but like, look, if you operate as a short-term rental and you self-manage it, it's an active business. That means you can take your losses from the real estate against your active income. This is really important because active income is all sources of active income. If you're a doctor, we're talking about, I was talking with a gentleman named Dave, who is a urologist. And Dave, if you're listening, shout out to you, man. But he is, we were talking about this exact thing where if he's going to take accelerated depreciation against his active income. His wife also is a full-time professional. So you can actually, and they will get a huge credit back because they've already paid those taxes. But what they'll do is they'll take that active property that they're managing as a short-term rental, and they will take accelerated depreciation, which in historically speaking, 25 to 30% of the value of the house is about what you can anticipate. You got to look at the cost seg. We'll walk you, if this is all news to you, we'll walk you through how to do this. But if, let's say you're buying a $300,000 property and you get a accelerated depreciation cost seg that comes back at a 30% accelerated depreciation, meaning you can take 30% in year one against all income sources. Well, that's roughly $100,000 tax deduction that you can offset against all your income sources, right? That could easily save you $30,000 or $40,000 of, and I'm just using round numbers here, but of actual tax savings. Instead of giving it to Uncle Sam, then you can actually use that money and reinvest it and earn income and a return on it. And guess what? Use it as down payment to buy other tax efficient vehicles and rinse and repeat, and you get this snowball effect. So let me just repeat this because I know I'm kind of going through this quickly and all over the place. So Adam, bear with me here. But what we've been working with our investors on with the guidance of your CPA over this past year is that we've had some high paid professionals. This is kind of what people refer to as a short-term loophole. But it's not, I mean, this is completely legitimate.
Yeah, short-term tax law is really what it is.
Yeah. So it's verified, with your CPA, of course, to make sure it'll work. But if you're actively managing it in the year that you put it into service, the year that you made it a short-term rental, if you previously made it, or the year that you bought it and you managed it that year, that's the year that matters, that you're actively managing it. After that year, you can turn it over to a property manager. You can use it as a short-term rental, long-term rental, midterm rental, whatever you want to do. You can continue to manage it because you find out like, hey, actually this isn't bad. Managing this property as a mid-term or short-term rental, long-term, and I'm actually earning more on it. It's kind of like a little experimental stage. But what it allows you to do is to actually take accelerated depreciation. So again, it's about 25-30% what we see on average. So if you're buying a $300,000 house, that means, you would take the normal $300,000 of depreciation over 27 and a half years, like you normally would, or 39. I mean, I won't get into that for now, but what that means is instead of taking that full depreciation over 30 years or 27 and a half years, you can take a big chunk of it, 30% of it in year one against all income sources. If you and your spouse are earning, $100,000 of taxable income that year, that could wipe out your entire taxable income, or it would make a huge dent. And this is huge because this is a way that people can take this accelerated depreciation by actively managing their property. And there's a lot to this. You got to write down hours and things like this. We'll make sure we have resources to share with you. But this is a huge way you can save dramatic tax benefits and really start this huge snowball. Because taxes are the biggest expense we're all going to pay. So, Adam, I could mumble on and repeat the same thing 1,000 different ways, but anything you want to add to that?
Yeah, I do. Because the way you need to think about it as an investor is, let's say you had that $100,000 and it saved you $30,000 in taxes. That $30,000, when you invest it, you should really think of that as getting an infinite return, because that is money that you never, according to the taxes originally before you bought the property, you never should have had. So that's kind of play money in some ways. And so when you invest that 30 grand and it makes any money at all, that's an infinite return on your investment because, it was free money. So think about it. If you think about it that way, if you do it, let's just say one a year, if you're doing it that way, then, in 2-3 years, you're buying a short-term rental with money that you never should have had in the first place. So you have a quote unquote free property just sitting there for you. So
Yeah, and depreciation is recapturable, right? I mean, you're required, by the way, to take depreciation by the IRS. It's not something you decide if you want to take it or not. The IRS taxes you as if you did take it, even if you didn't. So that's why it's important to have a CPA, not be filing your own taxes. But and again, we have CPA resources for you guys if you need them. But depreciation. Okay, so depreciation is recapturable. However, you can 1031 and kick the depreciation can down the road. And when you ultimately kick the can yourself and pass away, and you get a step-up basis to your children or heirs, and then you guess what? No one has to pay that back. So it's a way to perpetually, defer taxes forever in perpetuity, and never have to pay that, and then pass on a portfolio that has a step-up basis. They don't have to pay that depreciation back, and guess what? You created generational wealth and left a legacy. So that's just something to be aware of. But I always want to mention that because a lot of people don't know depreciation is recapturable if you sell that property and do not 1031 or do another tax advantage sale. Now I'm going to blow people's minds here, and probably I would encourage you to try to go through and write the math out on this. But guys, listen, this is the one. This is like the taxing, especially looking at the accelerated depreciation. This is the one thing that has allowed us to just skyrocket our portfolio, because we save. I mean, we've saved millions of dollars in taxes over years that we actually just were able to reinvest and not have to, and buy more assets and accelerate that depreciation to buy more assets and not have to give money to Uncle Sam that we're never going to see again. That's how dramatic wealth is created in rental real estate. Notice we haven't been talking about cash flow at all, right? We've been talking about building wealth, and it's playing the tax game, right, appropriately, you guys. Now, not everyone is in this position, right? But let me just throw this out there, and Adam, if you can give us some rough numbers with your calculator, that would be good. But I mean, this is something where I would highly encourage people to actually try to run the numbers and the math on this. But if you bought a $300,000 property and you're putting 20% down on it, what was that, 60K?
Yep.
Right. And let's say you take accelerated depreciation, you get $100,000 of accelerated depreciation. So that's reducing your taxable liability by $100,000. Let's say you're living in an area, let's say you're in the highest tax bracket, which I believe is 37%, plus, let's say you got a 6% state income tax or whatever the case is. So, I mean, we'll just round it to 45%. Okay. Or let's do 43%. So 43% of 100K is 43,000.
Yeah.
Right. So that's 43,000 of actual taxes paid. So $43,000, if I'm doing this correctly, divided by $60,000 as a down payment. What is your ROI on the money that just from the tax money that you've saved?
And that's like 63% or something like that. 64.
71.66666%. So
I guess it's over 2/3. Yeah. 71. Now, nice.
So I just want to look at this. Like, if you're looking at cash flow on a property as if it's, it's 6% versus 8% versus 10. And then, of course, there's the loan pay down, that's going to be 5%, but if you can create a scenario where you save like almost the entire amount of your down payment just by, operating the property this way and taking that accelerated depreciation, isn't that pretty dramatic? I mean, and then that's money you can, and then you were, like, to Adam's point on the infinite return, you're reinvesting that money to actually earn income on it. That's the biggest thing. It's not just like that's a one-time payday. That $43,000 is coming back to you because you've likely already paid it in taxes, unless you've had no taxable liability. So you're actually getting it back in your pocket to then reinvest. So that 71% return is actually significantly greater. But here's a mind-blowing thing. What if you bought that property with 5% down? Adam, run the math on that for me. What if you bought that? So that's 5% down would be $15,000.
$15,000, and you're still saving the $43,000. I mean, that's almost 300%.
Yeah, 300% return on your money. So, because there are credit unions out there, guys. Most of you who've been listening to us are aware of this. There are credit unions out there where you can buy up to 5 investment properties if you qualify for them, because they have strict qualification criteria with as little as 5% down. And then you operated them as short-term rentals, so they're active business, and then you ran accelerated depreciation. And you put $15,000 into the property. Now, of course, there's some closing costs as well, so maybe call it $20K or whatever. But you're getting $43,000 back potentially. Now, do not quote me on these numbers. Every property is different, right? You got to look at every situation, but the concept is there. And I just want to share that is exactly what I'm personally doing. That right there, because it makes all the sense in the world. I don't care about cash flow, at least in the short term, because those properties likely will be negative cash flow at 95% leverage, as they should, because you're almost leveraging 100%. But when you look at the tax side of it, it's huge, right? What if you bought $1 million worth of property? Let's say you bought $300,000 properties, which that's 1.5 million. And 30% of that is what?
450,000.
There you go, Adam. So that's huge, right? That's dramatic. That's going to save you a significant amount in taxes. So I'll stop there because I just wanted to share that. That's something that like we've known about and we've been working with people on, but like we've realized over time, like, hey, this can be dramatically impactful for people and makes all the sense in the world. Now, listen, it takes a little bit more work. You have to self-manage your property for the first year. You have to understand how you need to track your hours and things like this. This is not 100% turnkey, but it's not rocket science. It's not hard, guys, and it doesn't take a significant. It's not an 80-hour work week. Look, if you're out there flipping houses or trying to do something else, you're doing it the hard way, people. Do it the easy way, and that's the tax efficient way. And that's how people build wealth. So something to think about if you're interested to learn more. Obviously, talk with our team. But this is something that like kind of light bulb went off on in like probably a month ago. I'm like, man, people are starting to really kind of ask about this because we've mentioned it a few times, but we haven't really dove into it. And it's dramatically impactful. I mean, we have some people that are high income earners. They're saving hundreds of thousands of dollars of taxes that are now going to reinvest that money. And like those people will be millionaires. If they're not already, they will be in a very short period of time. And we've just like changed the trajectory of people's lives. And that stuff is just like, wow. Anyways, Adam, I want to share our 2024 goals with everyone as a company. Is there anything else you want to add to that?
Nope. It's like, I just want to encourage people, like we were just saying, you get on the bus before the bus is already driving away. I mean, you're having to play catch up and catch the falling knife.
Yep. And like that 5% down credit union, it used to be 0% down. We had a lot of people that bought with no money down. And so again, infinite return. It's just crazy on that. But the 5% down, we don't know how long that will last. I mean, that is just one strategy. And you don't have to put only 5% down because that will be negative cash flow likely. If you want to put 7% down, 8% down, I mean, whatever makes sense for you. Obviously, let's build a strategy and figure it out. But that is a way that, I mean, and also we encourage you to buy new construction in areas where you have really just like zero maintenance and really predictable returns. And in areas where we are seeing rental increases year after year. So that's another important concept. If you're only putting 5% down in your negative cash flow year 1, 2, 3, whatever, is like, as long as there's rental growth in that area to likely be positive cash flow at some point in time, I think that's a thing to safeguard yourself, plus having reserves. All right. So Rent to Retirement's 2024 strategic goals. Adam is already aware of these, and I just want to share them publicly because I'm all about like
putting it out into the world.
Yeah, man. Like, hold me accountable, right? If I'm going to say it, I've always had pride in being a person that does what I say I'm going to do. And Adam, hopefully you can agree with that. And that's kind of our company philosophy. But at least if I don't meet the goal, I've done everything I can to do that. So our strategic goals for 2024, which I think will be very exciting for many of you. The first one that's very easily quantifiable is we want to sell 80 properties a month. That is a strong goal because activity's been down over the past couple of years because of interest rates. But I think just because of where the market's at, like that goal will probably happen on its own. In addition to the fact that we are bringing a lot of new exciting things to the forefront that will cause a lot of people to take action. For example, some of the tech stuff I just shared. So 80 properties a month in the year 2024. Another thing I want to do is really we're ramping our Rent to Retirement Academy up. And this is something that if you haven't seen it, check it out. This is a educational platform where we put in like over 100 hours of detailed information for everything. That just doesn't matter if you're buying with us turnkey or you're just starting out investing, you're an experienced investor. These are the essential things that you need to know to understand how to get started investing in rental real estate the right way, how to build a strategy and a business plan, and ultimately create financial independence and generational wealth through real estate investing. This and guys, even if you're buying turnkey, like you still got to be financially savvy. All the like this tax stuff that we just talked about, that is one aspect of being a tax savvy real estate investor. And these are all the tools that you need to be a successful real estate investor. And guess what? This is also the course itself. So this is a paid course that comes along with coaching and guidance and group and individual coaching. We have all sorts of resources available. And we have incentives on this throughout the month of January, by the way. But this is something that we're putting a lot of effort into that we already have, and we're going to be continually increasing the amount of value. And this is a huge passion project because I really feel like we can sell real estate, we even turnkey, but we got to give people all the tools and resources. And there's just not enough, like we can have conversations with you regardless if you're an Academy member or not, but we are putting so much information into that, as well as what we're going to be adding to it over this next year, that it's just going to allow people to skyrocket their success. Because when we add the investments with the knowledge and the coaching and the concepts behind it, like those two together, the education and the coaching, along with the properties, like that's just the recipe for success. So we're super excited about that. Check out the Rent to Retirement Academy if you haven't already. And this is something where this cost will continually increase over time. You will be grandfathered in. It's lifetime access. There's no expiration, no ongoing fee structure. And you will be grandfathered into all the future value, but it will be increasing in cost over time. This is something also that people have been actually able to use to help them qualify as real estate professionals by documenting hours. Now you need to tie what you learn back to your own investment portfolio. That's the thing. But then we've been told by our CPAs that it will qualify as hours spent as long as you're applying it to your actual portfolio and improving that performance. Super excited about the Academy. We already have over 100 members. And our goal is to add at least 30 members to the Academy every single month in 2024. The next thing that I think is really exciting for myself and everyone else is we are breaking into the midterm rental space. And this is the first time I'm mentioning this, and we have not had any midterm rentals for sale yet. But here's the thing. What a midterm rental is we're basically talking about anything beyond 7 days or under. Typically, we refer to these as 30-day stays, but it's people that are traveling nurses, people displaced for insurance reasons, companies or military potentially, or government workers that are there for a short period of time, and they are living there on a month-to-month basis. Average stay is about 90 days, but what this means is that you move outside of a lot of the regulations and restrictions of operating a short-term rental. You still have to furnish the house, but midterm rentals are a way in a lot of these areas where you can increase the income on your long-term rental by on average 2 to 2.5%. And this is absolutely huge because what we found is there's a lot of areas, like not every area operates well as a short-term rental. You have to have, or at least not throughout the majority of the year, you need to have a really specific area to have a successful short-term rental. And amenities, like people are vacationing there. You have to have a pool. Like Southwest Florida, you got to have a pool if you're going to have a successful short-term rental. Right? People want the pool, and look at the competition. However, people that are just living there for 30 days because they need a place to stay and there's a housing shortage, they don't need all those amenities. Sure, it's nice, but like they're just there to work and be good tenants. And then they're usually professionals. And sometimes guess what? There's contracts with businesses that actually subsidize the rent, and you're not even dealing with a tenant. And they have to, like, they are required in their contract to be a quality tenant. You don't have to deal with missed payments and evictions and things like this. But the main thing is that you can increase the income on your property dramatically. Now, and then some areas there's like this hybrid model where, hey, your peak season is 3 months, then those 3 months, it's a short-term rental. The rest of the 9 months of the year, it's a midterm rental. And all of a sudden you've increased your income by threefold. I mean, it's just really impactful. Plus, hey, guess what? You operate as a short-term rental, like we talked about previously, for the first part of the year that you own it. Take that tax benefit, then maybe you can do more of a midterm rental part of the year, whatever you want to do. There's plenty of different ways to slice the pie on this, depending on the property and the location. But this is huge because it's a way we can really increase income for people. And we want to offer this in a turnkey route. Now, we're exclusively doing this with new construction and in areas that we know will be productive, and we'll bring you all the data points. We've been diving deep into this, and I'm personally experimenting with this first, as I like to do. That way we have some proof of concept. But essentially, with midterm rentals are going to be new construction in areas where we can kind of go two paths with our investors. One is the turnkey route where we actually have a management team or a hosting service handling that for you, or we're going to teach you how to do it yourself. So you don't have to pay managerial fees. Now that's obviously not turnkey, it's more involved, but guess what? You can, midterm rentals, guys, it actually does not require that much time to manage those. And you might be surprised by getting a little bit of a passion in that and something you can additionally learn as a side hustle to skyrocket your returns up. So Adam, I'm certainly excited about it. What do you think?
I mean, midterm rentals, the exciting thing to me about those is if you can find the right company, the company will sign a year-long, 2-year-long, 3-year-long lease with you, and then they handle the tenant movement because they basically say, hey, Adam, you're coming in for 30 days. Oh, your 30 days is up. Go away because we've hired Zach to come in for the next 30 days. Oh, Zach, your 30 days are up. And so you actually, if you can find the right company, the company becomes your property manager in a lot of ways because they're the ones figuring out who they need when and moving them out and moving them in. So,
and they're just writing you a check without missing a beat every single month. Now, look, here's the caveat with this stuff. There is more work involved, right? You have to do some more education, especially if you're going to be self-managing, like in the beginning. I'll say that in the beginning. And there's more variability, right? That's the risk because it's going to take a little bit of time to figure it out. And you may have a little bit more vacancy in the beginning. So that's my caveat for people is just know like, hey, with long-term rentals, especially if it's already leased, it's predictable. Like, as long as that tenant doesn't default on the lease, right? I mean, which is always up to the tenant, right? The lease is only as good as the paper. But that is something like you just know coming into it that there's a little bit more variability. But guys, this is the future, I think, in a lot of stuff where you skyrocket your returns. Now, and some of you may already have properties that are long-term rentals that you're thinking, hey, maybe I want to operate this as a midterm rental and increase the returns. Maybe I want to trial it out, right? Because you can always go back. You can always go back to long-term rental. I love all the areas that we're investing, by the way. These are going to be areas that have long-term, like the rents long-term makes sense. I only want to invest in areas where you have multiple strategies with the property, a fail-safe, where if we know long-term rentals, they work. If you just want to be an investor, just holds those, not thinks about it, and just cashes in on the cash flow and the appreciation over time, fantastic. If you want to be a little bit more aggressive and involved to try to really increase these returns and cash flow on the property and learn the midterm rental game, which will probably benefit you long-term, then you certainly could do that. Some of you may already have properties, especially new construction, that you're thinking, hey, maybe I actually want to do this. We'll help you through that process. And again, the Academy is going to teach people all about this, but we'll also have properties that are turnkey midterm rentals. And you need to furnish the house in the beginning. That's the additional out-of-pocket cost. That's another obstacle. So a little furnishing costs, a little bit more variability and vacancy up front. Other than that, long-term potential, I think, is huge. What was our last goal, Adam, that I was strategically talking about in 2024? Oh, on the builder side, bringing in new builders. We have a lot of new construction coming up. We really made the transition, and Adam knows this already, but I want to be 90% new construction homes. We still have the Midwest stuff. I think that's solid. That's a solid market for a $150,000, $200,000 house. Fantastic. But I think there's a lot of opportunity, at least right now, coming into this next year, where new construction done in the right market just really reduces your vacancy, your turnover, it's a more predictable return. You have less CapEx and maintenance on the property. You can do some of the creative things we're talking about. And I think that the new construction, we're really excited to bring a lot of new building partners and inventory to you during 2024. However, it is going to be a feeding frenzy, and that stuff will go very quickly. Academy members get exclusive access to inventory 24 hours before the general public. That's another benefit of the course. And of course, if you actually invest with us, you get the Academy to a majority paid for as reimbursements, because we're here to encourage you to take action. So I know I keep slipping in the little plugs for the Academy, but guys, look at it. It's on our website, renttoretirement.com/Academy. Talk with Adam. There's all sorts of incentives we're offering. But all those things combined, 2024 is going to be an exceptional year. We're very excited about all the things we're doing, and we are going to bring you guys everything we possibly can to be a successful investor, create financial independence and generational wealth through rental real estate. In 2024 is your year.
All right. I can't end it any better than that. So Zach, really enjoyed this episode. I hope it's been helpful to everybody else as they start off their year. As he said, head over to renttoretirement.com. You can check out the Academy. You can check out the inventory. You can learn more about us, see our videos, hear our other podcasts. That's at renttoretirement.com. And as we head into the new year, if you have any new questions, send them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. We will answer them in future episodes. You can also at renttoretirement.com schedule a time to talk with us so we can plan out your journey. Really appreciate the time you spent educating yourselves to start off the year. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.